Payments company Adyen reported earnings 10 days ago and the stock jumped 12%. Shares are now up 69% over the past year. At the latest price, Adyen's now got a market cap of 41 billion euros and an enterprise value of 39 billion. Revenue over the last 12 months comes to 1.8 billion euros with 826 million of net income and 846 million of ebitda. That means Adyen is now valued at 22 times revenue, 50 times earnings and 46 times ebitda. That's a rich valuation, but Adyen is clearly a high quality business, operating as a payment gateway, processor and acquiring bank for thousands of companies. Adyen is able to eliminate fraud and drive lower costs for customers, and this is highly profitable for Adyen, with over 45% of its revenue flowing right to the bottom line. And the company is showing excellent growth as well. Total processed volume increased 45% in the first half to 620 billion euros, with total revenue increasing 24%. Volume growth was seen across all of Adyen's segments: 50% growth in digital, 29% growth in unified commerce, and 59% growth in platforms. And there should be plenty of growth to come, both from existing customers and new ones. Adyen reported 30% growth in North America in the first half, which is an important highlight because it shows the company is taking share in the world's largest market. Adyen's land and expand strategy, where it wins small contracts first with customers before increasing its grip, is clearly paying off. And management thinks growth can continue in the low to high 20s over the medium term, with ebitda margins increasing to over 50% by 2026, and free cash flow conversion should be over 90%. That sort of outlook implies continued market share growth and operating leverage within the business. But it's not all good news. Despite a recent partnership with PayPal Fastlane, Adyen continues to operate in a highly competitive space, with the likes of Braintree, Stripe and Block. Adyen's take rate, which is the amount of money it gets for every transaction, declined again in the first half to 14.7 basis points. That's partly due to Adyen's focus on larger customers who can negotiate better terms due to the higher volume, but this is a key metric that investors are watching. But of all the risks, perhaps the biggest is valuation, since the company now trades at 50 times earnings. A simple discounted cash flow model that assumes 18% revenue growth for 10 years and a free cash flow margin of 50% results in an estimated annual return of 10% a year. That's with a 10% discount rate and a 2.5% terminal rate. So according to a discounted cash flow model, Adyen looks reasonably close to fair value, but DCF models aren't everything and quality stocks have a habit of beating expectations. That's why I give this stock a cautious bullish rating, but these are my personal opinions, not financial advice, and I do hold shares in Adyen. For more investing videos, make sure to join my newsletter at 3minutebreakdowns.com. Thank you for watching.